Welcome back to educator.com. Today we're going to look at the market for loanable funds. So let's dig right into the material here. We will do the following. We're going to describe how the loanable funds market matches savers and investors. Well, we're going to determine the causes of shift in both the supply and demand in the loanable funds market. We're going to differentiate between the real and nominal interest rate. And finally, we're going to reconcile the short run determination of the interest rate with the long run determination of the interest rate. So again, very, very simple, but this actually, there's a pretty high probability that you're going to see a graph of the loanable funds market on the FRQ portion. So not only is it useful for the multiple choice, knowing this is one of the big graphs along with the money market, and to see them connected together, it's going to be very helpful. So make sure you pay attention in this lecture. All right, so what is this loanable funds market? So this is something that, again, may sound a little bit strange if you're kind of if you're not very used to big pots of money and how it's invested and where money comes from. But loanable funds market, it's not that difficult of a concept. It's this hypothetical market that illustrates the market outcome of the demand for funds generated by borrowers and the supply of funds provided by lenders. Okay, so keep in mind, there are two groups of people. There are the savers, people that save the money, and therefore they're the ones that supply the loanable funds. And there are the borrowers, those that have the demand for the loanable funds, and therefore they're the ones that take out the loan. So savers are the ones who save the money and thus are more willing to lend out at higher rates of return. Again, that's the key here. So let's highlight this point. At higher rates of return. So very simple, 5% interest rate is much better than 2%. If I'm a lender, I am much more likely and inclined to give you a loan if I can get 5% rather than 2%. Now, again, adjusting for the idea that there's risk involved, I much prefer higher interest rates rather than lower interest rates. Again, that's coming from a saver. Okay, or those that are lending money, the supply of loanable funds. Borrowers, for example, firms with investment spending projects, they prefer lower interest rates. So again, using that same line of reasoning, 2% is going to be better than 5%. If I have this great project where, I want to build like $1 billion stadium, that's obviously going to be a huge, a huge undertaking. Let's say in the city of industry, build a $1 billion stadium, a new football stadium to get a football team in Los Angeles. Well, if the interest rates are lower, there's more likely that a firm is actually going to build it. If they're going to have to borrow money in order to come up with the project, if the interest rate is 10%, it just makes things a lot more expensive. And so lower interest rates are going to be better for borrowers or demanders of these loanable funds. So if you want to take a look at the equilibrium in the loanable funds market, it's very simple. It's where the quantity of funds that savers want to lend is going to equals the quantity of funds that businesses want to borrow. So there's going to be an equilibrium in the market, and that's how the amount of funds that are lent out in the loanable funds market. So this is basically how it looks like here. Now, one thing that you might notice here that's different than the money market, aside from the supply being upward sloping but not vertical, as is the case with the money market, is that we have the real interest rate right here, as opposed to the nominal. When you're dealing with the money market, you're dealing with a nominal interest rate. When you're dealing with the equilibrium in the loanable funds market, you're dealing with the real interest rate. So again, the supply of loanable funds is going to be an upward sloping. It's going to be upward sloping supply curve here, and the demand for loanable funds is going to be downward sloping. And so this is the quantity on the bottom is going to be loanable funds, and the intersection of supply and demand for loanable funds, that's going to be the equilibrium quantity of loanable funds. Now, if you want to write them out so you get it absolutely correct, that's fine. Or you could just label this as R. Okay, and you can, rather than writing out supply of loanable funds here, you could put loanable funds right here, and this indicates that this is the loanable funds. Just put S1 here. There's really no, it may be SL1, supply of loanable funds here, or S1. Really, as long as you have a consistent method of labeling, that's fine here. And here's the demand for loanable funds. Okay, so supply of loanable funds, 1 here, and demand for loanable funds, 1 here. And the intersection here is going to be R. So we call this R1 here. And this is the loanable funds here. You can label this as LF1. Okay, or actually, you can label this as the Q LF1 here. So again, you have a very basic standard supply and demand, except this is supply and demand of loanable funds. Okay, so let's talk about the shift of demand. So the shifts of demand of the loanable funds here. So there's two reasons why the demand for loanable funds might shift here. So changes in perceived business opportunities, and then changes in the government's borrowing here. Okay, so what does that actually mean here? So if businesses see opportunities of higher return, then the demand for loanable funds will increase. It makes a whole lot of sense. If there's a business climate where, people think that they can make tons of money, then the demand for loanable funds are going to increase. Conversely, if it's a very soft economy, things don't look well in the economy, then the demand for loanable funds is going to decrease here. So to give you an idea here, in the late 1990s with the dot-com boom, firms were excited about any possible internet companies out there. For example, pets.com. And the demand for loanable funds increased to the right. So in exciting times, people are going to want to invest in any possible thing that can make them money. And there is this irrational exuberance of things that were available. So the demand for loanable funds increased. And so the real interest rate would increase as a result of the demand shift to the right of the loanable funds demand curve. Another reason why the supply or the demand for loanable funds might actually change could be the changes in government's borrowing. So when governments incur deficit, the demand for loanable funds will increase. So what's going to happen is that there's going to be more demand for funds. When governments borrow, they're taking on other projects that normally they wouldn't have. They're going to finance that. So the demand for loanable funds is going to increase to the right, and it's going to raise the interest rates, because when you shift the demand curve to the right, then the equilibrium interest rate is going to go up. So the negative aspect, aside from incurring a deficit, is that there's crowding out that occurs when interest rates increase, and therefore businesses will invest less. So thus the crowding out effect. So one way you can actually see this is that there's a decrease in the supply of loanable funds to the private sector. You can look at it that way. But generally speaking, the correct answer is going to be a demand to the right of loanable funds. And therefore, it's going to crowd out private investment. So that's what's meant. The government butts in. They intervene with the private sector, and therefore less private sector investment actually takes place. Now, what can cause a shift in the supply of loanable funds? Well, changes in private savings behavior and changes in capital inflows. All right, so how the heck would changes in private savings behavior affect the supply of loanable funds? Well, let's take a look at between 2000 and 2006, so the 7-year period. Rising home prices cause people to feel richer and therefore spend more and save less. So the idea of, if you're living in your house and you live in your house and the price of your house goes up, well, you're not that cash richer, but you feel richer. If you live in a $300,000 house and, in a year, the home value goes up to $450,000, then there's going to be a greater likelihood that you're going to spend more money. So the supply of loanable funds actually is going to decrease to the left because you're going to save less and spend more. So the supply actually shifts to the left when you have less savings because you're going to spend more of it, right? So what happens here is that the supply of loanable funds, therefore, would shift to the left as a result of an increase in savings. Now, the converse is absolutely true as well. In between 2008 and 2010, let's say, with the Great Recession, the economic collapse in the United States and worldwide, you can argue that the supply of loanable funds increased to the right because people were now saving more and spending less. So if it works one way, it's going to work the other way as well. Okay, another reason why the supply of loanable funds will either shift to the left or the right would be changes in capital inflows. So with a large inflow of capital funds, so the supply of loanable funds is going to shift to the right. So if a lot of people flock to the United States, then the supply of loanable funds, if there's capital, then there's a capital inflow, and the supply will shift to the right here. Conversely, what happened in Argentina? Conversely, when international investors flee, like they did in Argentina during their times of hyperinflation, the supply of loanable funds is going to shift to the left here. So it's going to have the opposite effect, and it's going to raise interest rates as a whole. Okay. So let's take a look. What's the relationship between inflation? So if you look at inflation and interest rates, again, recall that, in previous lectures here, recall that inflation will tend to help borrowers and hurt savers. Okay. So, for example, in the late 1970s and the early 1980s, homeowners won with inflation and banks lost with inflation. So if you got a home mortgage and you got a 6% mortgage and interest rates were climbing up to 13%, then as a homeowner, you won because you're paying off a 6% mortgage and, banks are dealing with this 13% interest rate. So you have a situation where inflation, the person that's borrowing money wins with inflation, and the person that's lends with money loses with inflation here. So one formula here that I'm going to highlight and also underline, so to highlight the importance of knowing this, the real interest rate, and again, in economics, we care about what's real. We want to keep it real, okay? We don't want to keep it nominal here. So the real interest rate is a nominal interest rate minus the inflation rate, okay? So the real interest rate that you're getting, so the actual interest rate here, okay, let's use a thin red mark here. The real, you want to keep it real. The real interest rate is you take this nominal interest rate, whatever is stated in the terms, and you subtract the inflation rate. That's the real interest rate that economists really care about, not the nominal. The nominal interest rate could be 99%, and if the inflation rate is 99%, then the real interest rate is nothing because, you kind of subtract it out. Again, that being said, the fact that in the United States we have, the most common mortgage item is a 30-year mortgage. Yeah, people are going to end up paying, if they pay off their entire 30-year mortgage without refinancing, they're going to pay a lot more than the original value of the loan. But keep in mind, that the amount that they're paying is less as they spend it over time. And again, it's achievement to society that we do have a 30-year mortgage because countries with inflation, hyperinflation, there are no 30-year mortgages because, homeowners would love that 30-year mortgage if you have rapid inflation. Can you imagine in Zimbabwe, if you had a 30-year mortgage, you'd be able to pay off your house in less than a day with the wages and the inflation rate that was going on. So, kind of a sign of a stable economy perhaps would be, the amount of 30-year mortgages that are handed out, or at least the expectations of inflation. So again, to point out here, the true cost of borrowing is the real, not nominal interest rate. So the nominal interest rate can be whatever amount. When you're dealing with inflation, you got to cut that out and you get the true level of, or the real interest rate. Now again, a good hedge against inflation would be, to buy a house, take on a low interest rate mortgage, and then invest in other assets, perhaps the stock market. Now, you could see how this can also be problematic when you think the value of your house goes up, and so you take out these low interest mortgages, and then you invest in the stock market, and then the housing market collapses, the stock market collapses, and you have a big problem there. So again, it could be a hedge against inflation, but again, with any type of investment, you're going to deal with different risks there. Now, the Fisher effect is that the expected real interest rate is going to be unaffected by the change in expected future inflation. So again, this whole idea is that borrowers and lenders, they base their decisions on the expected real interest rate and not the nominal. So if there's an expected inflation rate of 1%, then borrowers and lenders, they adjust accordingly. So this is the idea that if there's a demand shift to the right of loanable funds, there's also a corresponding supply shift to the left. And the idea is that the money really doesn't matter. It's just if there's expected inflation, then the nominal is going to increase by 1% as well. All right, so how would an increase in supply of loanable funds look on a graph here? So again, you have R here. Again, this is the real interest rate now. Real interest rate. And you have the demand for loanable funds. Demand for loanable funds here. And here's the quantity of loanable funds. And then you have the supply here. Supply of loanable funds. Okay. And you have the equilibrium interest rate. So what happens when you increase the supply of loanable funds? Again, this is a basic supply and demand graph here. There's an increase in supply. Okay. What you have is you have a decrease in the real interest rate. And the quantity of loanable funds increases from the quantity of QLF1 to QLF2. So there's an increase in the quantity of loanable funds. So that's how an increase in loanable funds would look on the graph here. All right, so interest rate in the short run, so follow me here. If there's a fall in the interest rates, that leads to a rise in investment spending, okay, which leads to a rise in GDP, which leads to a rise in savings, okay? So what that means here is that in the money market, and we'll graph this in an example later on here. So in the money market, an increase in the money market is going to shift the money supply curve to the right, which lowers the real interest rates here. So in the short run, how's that going to affect the loanable funds market? In the short run, the loanable funds market follows the lead of this money market here. So this change in GDP is going to increase savings because people are now going to invest more as a result. And it's going to shift the supply of loanable funds to the right. Because remember, people aren't going to consume all of it. There's going to be some that's saved. If there's an increase in GDP, it's not going to be a whole, so the marginal propensity to consume might be 0.7. Well, they're still saving 0.3, right? So there's going to be an increase in the supply of loanable funds, and that's going to also decrease the real interest rate. So that's what happens to the interest rates in the short run. What happens in the money market has an impact on what happens in the loanable funds market. Okay. Now, interest rate in the long run. Again, this might be a little bit tough to conceptualize maybe unless we have a graph here, but we will get to that. But I want to explain it kind of as a story. So for those of you guys that are kind of a little bit confused, bear with me here, and then in the examples we will go over what's meant by this money market and supply of loanable funds here. So in the long run, however, when the money supply increases here, the aggregate price level also increases, and therefore the money demand increases in the same proportion here. Okay, what does that mean here? So let's use the labeling rather than using the money supply and aggregate price level here. So what you end up having is the MS1 here is going to shift to the right to the MS2. The money demand, however, also shifts to the right as well because of the increase in GDP. Now that's going to raise the interest rates back to its original level here. So basically there's no change in interest rates. Basically money is neutral. So the money has a short run impact, but it basically, if you increase the supply of money, it's going to lower the interest rates, which increase the GDP, which shifts the money demand curve. And so you're back to the same interest rates you were at before. So as a result, the supply of loanable funds, which originally shifted to the right because of the lowered interest rate, curve correspondingly is going to also shift to the right here. It's going to match. it's going to shift right back to the left, back to its original level. Okay, so basically this is the idea that in the long run, money does not matter. Yeah, I know this is an economics course and I think it's all about money, but yeah, economics really isn't about money. It's using money as a vehicle to explain a lot of different things here. So the supply and demand for loanable funds, that's what determines the interest rate in the long run. So that's kind of the whole idea behind this here. So example number 1 here. So let's take a look at this situation. So if the Fed sells government securities, what happens in the money market? And then what will happen in the loanable funds market in the short run? So in the previous lecture, I went over the money market, but now I'm trying to tie the money market to the loanable funds market here. So we'll draw this side-by-side graph here. So this is going to be the money market. So this is going to be the quantity of money. And again, this is the nominal interest. Let's call this R. And this is the money demand, MD1 here. And let's draw the money supply, MS1 here. And this is the quantity of money, so QM1 here. And this is R1 here. So if the Fed sells government securities, okay, let's kind of match this here on the right here. So this is the demand for loanable funds here. And you have the supply of loanable funds. And this is the quantity of loanable funds. And here's the real interest rate. R here. Okay, and then what you have here is the equilibrium in this market here. Let's call this R1 here. And so this is Q, quantity of loanable funds. So if the Fed sells government securities, now keep in mind, it's going to shrink the money supply here. And what's going to happen to the interest rate in the money market? Okay, so QM1, so there's a reduction in the money supply here. So you have QM1 turning to QM2, less money at a higher interest rate here. Okay, so if there's a higher interest rate, then you have a situation where if you go back to the macroeconomic equation, y equals c plus I plus g plus nx, what's going to happen is that the situation isn't going to look all that good. And so with that increase in the interest rates, the aggregate demand is going to shift to the left here. So the supply of loanable funds, people are going to have less money to save here. So the supply of loanable funds is going to shift to the left here because there's going to be a reduction in household savings there. And you have QLF2 here, and you have R2 here. So you're going to have higher real interest rates as a result of this situation. So similarly, if the money supply shifts to the right, you're going to have a reduction in the nominal and the real interest rates in the short run. So that's basically what's going on here in this graph here. Now, in the long run, if the Fed sells government securities, so same thing here, but now this is in the long run. If the Fed sells government securities, what happens in the money market and what will happen in the loanable funds market? Again, this is in the long run. How does that happen here? So I'm going to draw exactly the same thing, except there's going to be a different twist to it that kind of changes the entire game here. Okay, so you have the money market and you have the loanable funds. Now keep in mind, generally speaking, on the AP exam, you're probably not going to be able to connect these two things together. Who knows? You might have to do that. And so these are standalone graphs here, but it's good to know what the relationship is, and being able to draw them side to side and be able to connect it. It'll hopefully give you more confidence if you just have to draw one individually. Again, we did review the causes for the shift in the supply of loanable funds and the demand for loanable funds, but there is a connection with the money market here. So take a look here. This is MD1, and this is the quantity of money here. So again, to get that squared away here, this is the money market. And here is the market for loanable funds. Yeah. So here's the demand for loanable funds here, and this is a quantity of loanable funds. Okay, let's go ahead and deal with the money market first here. Go ahead and use all blue here. This is the money supply. And here's the R, or nominal interest rate here. And this is R1 here. So this is MS and MD1 here. This is QM1 here. Now, in the long run, if the Fed sells government securities, the money supply is going to shift from MS1 to MS2. Okay. Now here's the problem. Okay, we're in the long run here. So when the money supply shrinks, it raises the interest rates. And so what happens to the demand for money? Because now you've just changed the demand for money. And the idea is with higher interest rates, people are going to look at money as being more valuable of a commodity. And so they're going to want to hold less of it because they want to hold it in interest-bearing accounts. So the demand for money actually is going to shift to the right here. And so what happens to interest rate here? It actually goes back down to R1 here. Okay. So basically you're in this situation where you're back at that same interest rate here. So how is that going to play out in the long run for the market for loanable funds here? And so you have the quantity of loanable funds here. And so you have the supply of loanable funds. So initially there's a decrease in the supply of loanable funds here, R1 here. And again, this is the real interest rate. Okay. And what you have here is you have the real interest rate. And this is QLF2 here. And the real interest rate increases. But again, as the money demand here, let me label this here. As the money demand has decreased, the interest rates have gone down. Interest rates have gone down. Well, what happens to what happens to the supply of loanable funds? Well, the supply of loanable funds is going to increase and go back to its original here, supply of loanable funds, because people are they're gonna save a little bit more, and so you're back to that original quantity here. So you move from point A right here to point B, right back to point A. Okay, so in the long run, basically the whole idea is that money really doesn't change a whole lot. Money is people will kind of adjust to that situation. Okay, example number 3. The real interest rate equals which of the following? So option A, nominal interest rate plus the inflation rate. Well, we know that's not true. So that's clearly a wrong answer. Nominal interest rate plus the inflation rate is not going to work out. Nominal interest rate minus inflation rate. That's the real. You want to keep it real. This is the correct answer. So I'll put a check right here, but not quite sure. Let's look at the other responses. Nominal rate divided by the inflation rate. Okay, so that one makes no sense. So clearly that's wrong here. Nominal rate minus the discount rate. Okay, so these two rates aren't going to really calculate accordingly here. And the last one here, the discount rate plus the federal funds rate minus the square root of the required reserve ratio plus the number of days in February in 2016. That's probably going to be wrong. Now, is there a possibility the numbers might coincide? Yes, maybe, but very slim probability. And so the correct answer is going to be B. Your nominal interest rate minus inflation rate, that's going to be the real interest rate. Okay, and then final example here is the following here. Does each of the following affect either the supply or demand for loanable funds? And if so, does the affected curve shift to the right or shift to the left here? So I'll go through each of these 4 situations and then determine if it's the supply or the demand for loanable funds. And then I'll I'll go over the directions here. So decrease in capital flow. So capital flow, this is supply of loanable funds. So I'll keep that blue here. Okay. Businesses are optimistic about future business conditions. Okay, I'll use green right here. This is demand for loanable funds. Just to be consistent here, I'll put loanable funds as well here. Okay, the government decreases borrowing. Haha. Okay, this is the idea that when will the government ever decrease borrowing? You might find that funny. You might not find that funny here. But this is clearly going to be another demand for loanable funds here. So I'll use green here for demand for loanable funds. And then finally, the private savings rate increases. Again, this is a supply issue because that's going to alter the supply of loanable funds. So the correct answer here is supply of loanable funds. Okay, now let's go back to A right here. There's going to be a decrease in capital flow. So that's going to shift the supply curve to the left. There's less supply of loanable funds. So it's going to be decrease. So shift left. Okay. Now businesses are optimistic about future businesses. So they're optimistic, so the demand is going to increase. So it's going to increase. And therefore increase, and again, they want to know if it shifts, which way it shifts, to the left or to the right. Increased, which is a shift right. Okay. Government decreases borrowing, so it's the opposite of crowding out effect. Instead of a demand increase, there's going to be a demand decrease here. So there's going to be a demand for loanable funds decrease, and that's going to shift to the left. Now I have a demand decrease left, demand increase right, supply decrease left. This is probably going to be supply increase to the right, but let's make sure you read this problem before you jump to any conclusions. The private savings rate increases, and that is correct here. So the supply of loanable funds is going to increase, and therefore it's going to shift right. So hopefully you got a sense of how to draw the supply for loanable funds graphs and see the connection in the short run versus the long run, and how it ties in with the money market. Thank you for watching educator.com.